If you're considering buying a house versus a unit, then this is the video for you. In today's video, I'm gonna share my personal experience as an investor who's bought both. I'm gonna talk about a whole bunch of the data from some of the big boys so that you can make a better decision for yourself. I'm gonna talk about my clients' experiences in Sydney, Melbourne, and Brisbane and what they've done and what results I've seen from what they've done. So again, you can make the most educated decision. So when I was 24 years of age, I was working at IBM and I decided to buy a first investment property. Now, it took me about a year to save that deposit, and I went out there, I saved my money, I looked at the market, and then I did the same thing that most investors do. I bought 5 minutes from my home, I bought the cheapest property on the market I could find, which ended up being a unit in a suburb called Miranda. Now, I bought that unit for $360,000. If I had have kept it, that $360,000 purchase in 2011 would now be worth around about $700,000. Had I at the same time bought a $600,000 home just down the road in the same suburb, that home would have been worth about $1.5 million. Now, don't get me wrong, I would have been absolutely stoked by doubling my money on both of those properties in the last 10 to 12 years. But on one of those examples where I had spent a tiny bit more getting a quality home in a quiet street with a bigger block of land and a good home on it, I would have been $900,000 up versus being only $340,000 up if I had have kept that unit. That sort of got me thinking big time about the same question that you probably have at the moment, which is, do I go out there and buy that more affordable unit that gets me into the market sooner, or should I save a little bit more cash, stretch myself, or look at a market a little bit further away from where I live and buy that house? Now, thankfully, the data has caught up with what I'd learned personally from my own experience. Now, houses in the last 30 years in the capital cities of Australia have gone up by 453%, which is an average of 15% per annum. Absolutely insane growth, where units over the same period of time have only gone up by 306%. So we're talking about 147% difference, which may not sound like a lot, but on a $500,000 home may have been almost a $500,000 difference between spending the same money on one asset versus the same money on another in a slightly more affordable market at the time. I sort of thought, well, that might make sense for a metro market because we know that people favour houses and land close to the cities and closest to the beaches in Australia. So I went and looked at the core logic data around the regional markets, and I went, well, what have houses in Australia's biggest regional markets done, and what have units done over the last 30 years? Now, the same thing was almost true. Houses in the last 30 years had done 313%, where units over the same period of time had only done 212%. So that was 100% difference again, leaving massive amounts of money on the table. Now, absolutely no investor in the entire world or homeowner that should be leaving 100% plus gains on the table. The third and final nail in the coffin for me personally, though, as an investor who runs a buyer's agency and has been lucky enough to talk to maybe 3,000 or 4,000 investors over the last 7 years, is them sharing their experiences. Now, the beautiful thing about talking to so many people, some of which are just starting out, but some of which have bought 15 to 30 properties over their lifetime already, is that I learned my lessons from those guys. And from speaking to these guys over time, there was just time and time and time again where I saw people buying units 10 years ago in Sydney or Melbourne or Brisbane, and asking them, well, what did you buy it for? And what is the unit worth today? And in so many examples, particularly when they bought brand new stuff off the plan, I saw that, yes, in some instances, they may have made small amounts of money, maybe a couple of $100,000. But in most instances, most of the people that had bought those units had all said to me that if they could do something again, they would have bought a house at the same time instead of the unit, because their unit may have gone up by a couple of $100K, but the houses that they missed out on that they could have bought at the same time have gone up in most instances by more than $500,000 to $700,000. So For me personally, I am absolutely going to focus on houses for the rest of my journey as an investor. It's not just my own experience, but it's the data and the experience of thousands of investors that have learnt the lesson the hard way. If you're sitting on the fence at the moment, I massively encourage you to go look at this core logic stuff yourself. And if you can, buying a house will not only give you the best return on your investment over the longer term, but it will massively reduce your risk because the return, historically speaking, has been much stronger. It'll mean that you can get choices in your life and financial freedom for yourself and your family sooner, which ultimately means that you can do what you really want to be doing, contribute to the world in a more positive way, spend more time with the people you care about, train more, look after yourself better, volunteer, travel overseas, and really live that rich and fulfilling life, which is really what investing in property is all about.
Woo! That's a wrap.
That's a wrap.
Getting
Have a
cool,
spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.